What up everybody, welcome back to Royal Blu FX. In today's video, we're going to do another quick recap video on the trades that we've taken as of yesterday, which is Monday the 24th on October. We did the trades on US30 as always. Also, for those that are interested in buying our course now comes with unlimited one-on-one coaching and support for a lifetime. Get our course today at RoyalBluFX.com. Now let's begin.
Yes, I would. Got a big check. Will it spend right? Will it not so? Let me get high. It's a new feel.
Alright, so first things first. We start on the 15-minute time frame because that is our higher time frame, and we scalp all the time. So what we did was we focused on this area right around here on Monday the 24th, and I believe it's the 24th. Let me check here. Yes, on Monday the 24th. And so we took 3 trades, okay? So what we did was we zoomed out a little bit, right? What we always do is speculate we analyze the market and look at what's happening here. We saw that we had a lot of liquidity from here because there was a high here and another high here. Price went up, swept this liquidity, and pushed bearish here. Now, I was I always trade the US30 Open, or the New York Open, excuse me. But unfortunately, I was cooking at this time, so I wasn't able to trade the US30 Open, which is okay because I will show you what I did over here. Let's push this over here, and let's go into this. Okay, so once I mark out all the liquidity here, I always go down on the 1-minute time frame just to kind of see the behavior of the markets and seeing what it's actually doing. And the reason why I do this is because obviously I want to be in the right direction of the market to trade at all times. So when I drop down here the 1 minute, I saw quickly here there's more liquidity there. There was a break here, right? And I saw there's more liquidity down here, right, where this impulse move happened from here. So we had a sweep of liquidity right down here. And what's really interesting is I'm going to do a video about sweeps of liquidities probably tomorrow or sometime this week, and talk to you guys about what sweeps of liquidities are. But this is a sweep of liquidity right over here, and this is very attractive demand zone, excuse me. So that's why I came and looked at this area. I was focusing on this area a lot. Once I found that there was a break of structure that we had here, there was more liquidity building over here. And then we noticed that we had another sweep over here, and so therefore we knew again the supply zones are very attractive, supply and demand zones are very attractive from where the sweeps of liquidity happen. And then once I saw that price mitigated our demand right over here, I went right directly into our 5 seconds time frame. You can notice that I marked out liquidity on the 1 minute as well. So I always mark out liquidity because we know that is the fuel for the markets. And here, as you can see, I marked it here on the 1 minute, obviously. I marked it here on the 5 seconds. I can see more here. And then once prices mitigated here, I looked for the impulse, like anyone should. You should always look for the impulse. The impulse forms a chalk formation. You can see it right here. There's a low that was broken here, and there was a high being broken here. So I was a little late into the game right over here when price broke. It didn't really mitigate my demand zone, which is obviously okay. But what I did after this was when price broke a new high here, I was able to adapt to the new break of structure. And then, of course, what do we see here? There's liquidity again, which tells us when price creates liquidity, it normally comes and takes that liquidity and pushes back the intended direction. And we knew this was bullish. We're looking for buys here because of this major demand zone and because of the because of this area down here, right over here, where price took out all this liquidity and then came all the way back down here. So we trade liquidity away from liquidity. We don't trade towards liquidity, even though we know that markets do have the intention to go towards liquidity as well. But it's really important for us to be trading away from liquidity. That's the main key here. Once we entered here at almost about 0.5% risk over here, I would probably say about 0.7% risk here. And we were able to target this high here, this supply zone. And the reason why is because we had more liquidity there. And again, at times the market does like to go towards the liquidity and take out that liquidity, but you should never be trading towards liquidity. for the mere factor of because the banks don't always go towards liquidity. They go to mitigate also, but they don't always go to mitigate. So it's about a 50-50 chance where banks like to go to mitigate an order block or to mitigate, and they also like to go towards where there's liquidity, and that's all. So let's look over here. So once we traded, we always take about 5 to 6, sometimes even 7% partial into the trade, just so that we can secure some profits. Right? You did all that work, so you want to be able to pay yourself, obviously, just in case price goes against you, and then you start regretting the trade, right? So once price pushes up, right? Every time it goes up a little bit, we take about another 2 to 3%, just to keep paying ourselves, right? And so right here you can see where the supply zone wasn't mitigated at all. Prices started going bearish here. What I quickly noticed was that when you zoom out here, I didn't see this quite yet over here. From this high to this high, right over here, I saw it, but I didn't mark it. And once I saw this area here push right to the highs over here, it swept this high liquidity, right? It didn't actually sweep this high, this major high, and this high here, although it swept this internal high here and this internal high's liquidity, right? So I told myself, okay, well, I see the chalk boss, I see the aggression first. That's the most important thing. Then we have the chalk, which is another important thing, part of our rules too, right? And then we have our entry. We have our risk right above. We're ready to go for it, and we're targeting this low, this demand zone, only because we have this area here that wasn't mitigated just yet, right over here. So I was able to target this demand zone here, knowing that price may not go bearish from here that far. Because we're looking at this very short term. We're not looking at this trade very long term. Okay, when you're a scalper, you look at everything very short term. So we were quickly in here, right? We paid ourselves about 5% of the way, and then price just dropped again dramatically. We took another 3% here, and then we just let the rest run. And then this is what happened right here. So right over here. Okay, so price went up, and I was like, all right, this is fine. Well, then what I did here now, I just broke even a little too early, and I'll tell you why. Sometimes it's not good to break even too early, because since I sold it from this high right over here, I'm still positive. I'm still in the positive. I'm still positive with my trade. So what I quickly did was I kind of regretted that I took out my money, the rest of the capital over here, when really this is where I sold it. So had I stayed in, I would have been able to collect more profits on this. I would have been able to really liquidate this whole market here, but that's not what we did. We just stayed right here, and we cut off the trade as soon as price kept going bullish here. So that's something not smart to do, obviously, but at the end of the day, you learn. But I'm going to talk to you about this big trade here that we're looking at right now. So what did I do here? Well, I saw more liquidity. There was more buys here, more buying pressure. You can see that there's these are the relative low, relative double bottoms here that we like to look at. They're not perfect double bottoms, which is excuse me, excuse me, the perfect relatively looking double bottoms that everyone likes to look at, which is the perfect double bottoms, which is a low here and another low here. So what I quickly did was I zoomed out again just to kind of see the scope of things and seeing where we are. If you see over here, I marked out more liquidity. Let's go on the 1 minute. Maybe we can see this a little bit clearer. Right over here, you can see that we have a trend line liquidity where prices have bought, buyers have bought here, here, and here. So this is our generic retail traders way of trading, right? They look at a low and they buy. They see another low there, so they match that other low from that previous low and they keep buying, right? So what we saw here was this was where all the pool of money was, where all the stop losses were right below. So this indicated to us, okay, there's a ton of money there, so we got to see where our order block is, and it was right here, okay, right below all the liquidity. And so I waited patiently for price to get there, and then lo and behold, when prices got to the demand zone right here, let me just play it a little quicker. All right, so once prices got here to our demand zone, I didn't just strike randomly. I didn't just strike at this demand zone. What I had to do was I had to wait to see for the aggression to create, and there you go. you can see that there I had a chalk build right over here. I had two of them. This is one, this is the other. Now the reason why I marked this one out is because even though it didn't mitigate, it did create a chalk. I was waiting for confirmation here just to see if I could buy here, and it didn't happen. So price just then fell aggressively bearish, which is totally okay. And we noticed that obviously our demand zone hasn't been tapped. Now it's really important that your demand zone or supply zone is always tapped, because if there's no demand zones or supply zones and this here randomly happens like this, right, by not having your demand zone touch, then this may not be your potential entry. You always want your demand zones or supply zones to be tapped. And so here we got that confirmation, and as soon as we got that, we immediately waited for the chalk to appear. You can see that low being broken, the high being broken, right? And this was our entry here. Now, my trade says I took it here, which I did not. Took it specifically here. Just right when, as soon as it tapped. And you can notice that I put my risk right below, just a little bit below the wicks over there. And the reason for that is because I'm trying to not have the market come and take me out. Right now, of course, maybe it would have been a lot more smarter if I had my zone even just a little bit low like this, right below the demand zone. The reason why, again, is because you don't want the market to come against you to take you out, and then you have to forfeit the trade, right? You have to get out of the trades. But this is what happened. So once I took this entry, right, I just stood in it. You know, as soon as price pushed up about 5 to 6, sometimes 7% of the way, I can see when prices really impulsively moving to the upside, I wait for about 6 to 7%. It's my love for the percentage. That's my sweet spot, right? It's my sweet spot for the 7%. And so once we did that, we pay ourselves, and now we just let the whole thing run. And now I don't have to feel bad about the trade if the trade should ever go against me over here. I'm really liking the fact that I've paid myself, and I'm really good. I'm happy, right? The whole point about my methodology in terms of trade management and trading is to not be too greedy in the market, right? There's a point in time when a lot of people are too greedy and when people are too fearful. I want to be in between those, right? I got to play it safe, and in order for playing it safe in the market is to manage your trades well, right? So as you can see here, I paid myself about 7% of the way. Once price pushes up about another 2 to 3, sometimes 4%, I'm able to pay myself a bit more. Now my ideal target was the supply zone, as you can see here. The only reason why is because we had more liquidity above here. And my anticipation was thinking, okay, well, price could just tap, break a new chalk here, and then push bearish. But fortunately for me, I was in a safe place only because I took two partials, one here at about 7% and the other one about another 4% of the way. So I was staying really healthy here. I told myself if prices should ever go against me here, I am all good. I can stay, if I lose it, that's totally fine. It has to come all the way back down here, and I would be able to break even. That would be no problem for me. I'm still a win at the end of the day. So prices kept doing this for a good hour, and you'll see what I'm talking about once I'm playing it. Let me just go a little faster here so you guys can spot this and see. So notice how prices are coming bearish here, and it's supposed to. It should, only because we had just liquidity swept here and here, right? We had the supply zone. I was looking for a sell here, although I didn't hedge it, selling it off. I was just being patient, really. A lot of the times when you're hedging, you do want to pick the best trades, right? The best hedging trades. You don't want to just be trading, buying and selling anything you see in the markets. So this gave me enough confidence the price was pushing bullish here because we broke a new high now, and we broke the supply zone. So buyers were here. We can see a lot of buyers pushing bullish here, and this is what's giving me a lot more confidence to stay in this trade. Now again, prices could just turn right, towards against me here, right? But they haven't, only because prices are bullish. You can see that here we had more sweep of liquidity. There's a buy here, another buy. Here's that sweep right here. This is the low that swept all this liquidity, and prices are pushing bullish now. Now, I could have bought again, but I didn't. I just wanted to wait and see what was happening. We had a lot of ranging happening in here, as you can see. Very unhealthy. But at the end of the day, I was looking at the longer term for this trade. When I went right on the 5-minute and the 15-minute, I could see the prices were pushing bullish. It's just like Warren Buffett always says, in terms of the way he invests is he looks in long-term investments, right? So what I like to do is I look at the long-term trade that the markets are, or the long-term positions that the markets are presenting me with. Okay, so right here again, what are we doing? We're just being patient. We're waiting for prices to continue, right? I hit TP right over here at this high, and this was about, I would say, about 10 p.m. at night, my time, and we were able to reach this high. Excuse me, let me just see what's happening here. All right, my computer's lagging a little bit, but it's moving. Okay, so let's go back. Let's go on the 1 minute here. I want you to show you guys what it looks like on the 1 minute here. So naturally, I just extended my profit all the way to this high because we already surpassed that supply zone that I was talking to you guys about. Let me just zoom in over here. It's a little pixelated. It should show full-size candles here, but that's our supply zone that we were targeting, which we met. We're trying to target this high now only because that's where price is going to go. Based off of this major liquidity sweep from this low here, it was swept, prices pushed bullish here. That's what indicated to me, that told me that this was the next target. So let's continue here. And it took a while, obviously, and the beauty of trading long-term is that you can have peace within yourself, right? You don't have to feel like the market's manipulating you or whatever. It takes a whole lot of time for price to come back here to take you out, if they ever should, on the longer term. All right, so prices are going, and I got notified when price hit this high over here, right over here. So we just hit that TP right over there. Now I want to show you guys this. We made 33.8% on this trade, which is very healthy, and so we made some pretty good percentages overall in the entire day, and that was the rest of the trade. Now I was thinking to hold this trade all the way over here to the supply zone, right over here, and I just cut it off during the night. I usually don't like to sleep with trades running. Now I could have left it running, obviously, because we did pay ourselves very handsomely here along the way. Notice every time price pushes up, I'm always paying myself about 2 to 3 to 4% of the time when price is pushing bullish. And I paid myself so handsomely that I thought, okay, well, I could sleep, and if prices ever go below my, come here, they would just take me out of break even, which is totally fine, right? I've paid myself. I'm only focusing on one trade to make money from. That's it. And if I just take this out now, you'll see what I'm talking about. Right over here. You can see where the trade is ending right now. Right over here. Okay, so had I slept during the night, right, it wouldn't have taken me out at all. I would have still been in this trade for a long time, right? So we're talking probably a good 15 17 hours from here, since the trade from here, it was 7:20, so let's say it's just 7:30 right at night, to say, come on, computer's lagging here, to say 3:23. So literally we had a pretty big time difference. Yeah, pretty big time difference from when I started. Right now, naturally, prices just push up from here. I'm not trading any of this right now, only because it's not 6:30 my time. And once it turns to 6:30, I'll be able to look for potential buys here. But right now, I'm not looking to buy at all. Anyway, guys, I hope you guys learned a lot from this video. If you guys really enjoyed this video, please throw that huge thumbs up and a huge thumbs up to this video, and subscribe to this video, because we always leave out good content. Guys, I hope you guys liked it again, and I will see you in the next.
This time, what you think about?